Welcome, ladies and gentlemen, to our Lunchtime Summit panel session, the Global Economic Outlook for 2024 at the London Investor Show. I'm Nadira Tudor, and I'm going to be your moderator for the next session. Delighted to be here today. And just a quick outline of how things will work or should work. This is a completely interactive session. We are reliant on you for your questions, so really have them ready. There'll be someone with a microphone who'll be coming around, and just put your hand up when I open the floor, and hopefully we'll get a microphone to you ready. We've got a wealth of knowledge on stage, which you'll be hearing about in a minute, so please make the most of this next 50 minutes. It's going to last about 45 to 50 minutes, and it is your chance to pose those questions, open floor sessions. So, the annual Lunchtime Summit at the London Investor Show takes a global view, with the panel discussing different areas and considering where the most exciting opportunities lie. On a general note, the panel will give their thoughts on current global economic policies and how these will affect private investors and traders during 2024. So, without further ado, I will introduce our panelists to you. First is Yohei Elam, is the product manager of FX Street's premium offering and a senior financial analyst. He's been in foreign exchange since 2008, when he founded Forex Crunch, which is a blog that turned into a currency website, and specializes now in fundamental and political analysis and covers technical and educational content. He's collaborated with many outlets such as FX Street, Forex Factory, Business Insider, and many more. My second guest is Mark McAvee. I hope I've pronounced that right. The Editorial and Insights Director, Research and Finance. Obviously, you're doing loads of collative work there. Mark has actually got more than 12 years' experience in market intelligence, data analysis, and publishing, mainly focused on research into sales and product development trends in the asset management industry. And he has a strong understanding of cross-border mutual fund distribution dynamics, particularly in Europe. Then we have Wanda Rutgers. Wanda is the Chief Operating Officer at Lightyear, and he joined the company as an investor in the first round, advising Martin and Mikhail on compliance, operations and business development, before joining the business full-time as COO in May 2022. At Lightyear, Wanda is focused on building out the brokerage, compliance and business functions to support growth and expansion. And my final guest on stage is Dan Jones. Dan is Deputy Editor of Investors Chronicle and has been a financial journalist, I like the wave, for more than 15 years. He was named the CFA Institute's UK Trade Journalist of the Year. Well done, in 2018. I think a round of applause for these panelists first, before we start. Oh. No pressure.
Thank you.
Dan, let's start with you. Your initial thoughts on the global economic outlook for 2024?
Well, it's a tough one, isn't it? I mean, coming into this year, if we think back, the mood was pretty bleak, and as it stands, perhaps things haven't been quite as bad as people expected, albeit they've not been amazing either. Going into next year, it's fair to say the mood, I think, as it stands again, is quite downbeat. So it's difficult. I think the key question, it's not really a surprising comment, but the key question really is still about interest rates. Last year it was, when will they peak? Now the question is very much, when will the cuts come? Over the past few weeks, couple of months, we've seen investors, I think, realize that the higher for longer mantra that central banks like to say is more of a reality than they perhaps thought. So on that level, maybe there's not much to hope for, but one strange way of looking at it perhaps is that the more that investors believe the higher for longer mantra, the more inaccurate that will prove to be, because we've seen bond yields rising quite a lot in the last few weeks as investors think rates aren't being cut anytime soon. But that, of course, creates pressure, and ultimately that pressure will cause central banks to rethink. So may well be that next year is the year of a rate cut or two, and albeit we're not going down to zero anytime soon, and this is a very macro point of view, but we are being dominated by macro forces at the moment. And when that pivot does come, or when those rate cuts are drawing near, that's really when you can expect, I think, sentiment to to shift, and it might shift very quickly, and that might be a big opportunity. I mean, we at Investors Chronicle, of course, focus on individual companies, and their fundamentals will keep changing on a day-by-day, week-by-week basis as results come in. But really, at the overall level of sentiment, which is the real problem for a lot of investors right now, I think that switch could be coming next year, and that's what we've got to look out for, really. I mean, I'm sure we'll get into individual markets, individual sectors and companies shortly, but that's the big overriding thing for me next year. In the UK, of course, all of us here have a particular interest, I would imagine, in the domestic market. That moment could come sooner than elsewhere. The valuations in the UK, of course, look more attractive than elsewhere too. That said, we were probably saying the same thing this time last year, so patience is needed, but there is an opportunity coming down the line, I think.
It's kind of a bit optimistic, I think. Hopeful at the same time. Yohei, I'm going to move to you. What are your initial thoughts? If you can share with the audience.
I want to disagree to keep things interesting, but I cannot disagree. I'm also relatively optimistic. I think central banks will jump to the rescue. There's a growing urge from the public in Western countries to have governments more supportive, and now we're going to have, the effect of higher interest rates, higher yields for some time. At some point, it'll become a problem for governments, and I think with a bit of falling inflation and higher costs, I think central banks will eventually come to the rescue, lower interest rates, and especially halt their quantitative tightening processes, so slow down the level at which they squeeze their balance sheets and let bonds go on the market. So I think we'll get more support from central banks than it seems right now, and that'll be a positive for the stock markets going forward.
You've got a very different view from Dan, haven't you? When you think of that initial outlook. Mark, I'm going to move on to you.
Yeah.
Okay, my view might be slightly different. Coming from a research agency, I'll sort of present the view of the investor at the moment. We speak with thousands of investors, both private investors and professional investors in the UK and Europe every year. We run a study just ahead of this conference, actually. I can't say too much about it because my boss will be presenting the results in about an hour and a half. I don't want to steal too much thunder. But some of the initial findings based on UK investors, private investors, some of whom may well be in the room if you took part in the study, thank you very much. Sentiment's looking better than last year. That's probably not difficult to achieve given what was going on last year, but it is looking up. Confidence in the future looking up a little bit. Confidence in the UK economy, not so great, fairly flat compared to what we saw last year as well. That said, when you then look at investment intentions and what people see as the most attractive opportunities, there is still quite a strong home bias amongst the UK crowd for UK equities, say. Not too surprising, I guess. If we broaden out the view to the professional investor universe and start thinking about what investment advisors and DFMs are thinking, the tone there might be a little bit more cautious compared to your private investor. Definitely slightly more risk off than risk on for the coming year. A lot of talk about needing to up exposure to fixed income in particular. The questions we're putting to them are a bit more holistic as opposed to what sort of equity strategies investors are looking to go with over the next year. But I can definitely see some optimism there. Of course, the markets can change very quickly, and we'll have to see how the coming months play out. But yeah, we can also perhaps go into some of the themes in a bit more detail later on in the session.
Yeah. Last but not least, Wanda.
Thank you. So we're building a brokerage. Ledger is a multi-currency brokerage across Europe. And we kind of look at the macro trends from the point of view of our users. Like we try to build products for our users for this year and next year that play into their needs and their behavior. And I think one thing that I agree with, that the main theme that they worry about is interest rates and whether they will stay high. And what we've seen a lot this year is that people have put more of their money in cash and fixed income products. And they care a lot more about making sure they get as close to the risk-free rate as they can on their money, which is why we built products for that in terms of interest and money market funds. I think they also see that if we talk to them about the next year, that uncertainty around what's going to happen in the global macro environment is quite high, and so they care a lot about getting the most of their returns with avoiding high fees and making sure that that they don't lose on that. But last, I think also I'd echo some of the optimism where they're bullish that as equity prices are down, it's also a good time to identify stocks that will take them a while.
You're on the ground, Wanda. I just want to mention that. So you see how people act, the nuts and bolts, as you put it in our conversation earlier. Does what you see match what Dan's saying, for example, and what Mark's saying, or does it match more what Yohei is saying?
Well, I think it matches a lot this view of that interest rate dominate, and that the fact that you can get such attractive attractive yields without taking any risk has meant that our users are moving their money into money market funds, and they're caring about slightly different things, which is making sure that they actually get those yields in, and you see some of them, they're sitting out the market waiting for the right opportunity to get back in. And I think they're asking themselves the question, when is that time? And what's the point at which the risk premium you can get from being in equities more is worth getting out of these like sweet risk-free yields. So yeah, we see that exactly.
Thank you. Now, just so you know, the audience, before we had this discussion, obviously we've got quite a mixed panel here. I asked each of them to throw a few questions that they'd feel comfortable, but actually what I'm going to do, which is a little bit of a trick, is I'm going to use some of them and then throw them over to everyone else and see what they come up with, because they'll all have a bit of an opinion, and you will too. It'll probably help you formulate your own questions as well when I open up the floor. Mark, I'm going to start with you, and I quite like this one that you posed, which was, is responsible investment dropping down the agenda from what you've seen?
It's not dropping down the agenda, but it's definitely evolving the way that people view it, both private investors and professional investors. There's quite an evolution going on in that sector, I think. Perhaps some frustration that's been mounting over the years. Obviously, greenwashing is a word that comes up a lot. Struggling to understand what's going on underneath the bonnet of the products that people are buying, because there are so many different methodologies, so many different labels or disclosure regimes around them. And one thing we've really noted this year in our research has been a drop-off in the expectation that ESG and responsible investing equates to outperformance versus non-ESG or non-responsible investing. That's not to say people are thinking it's resulting in poorer performance. It's become a much more neutral view on that front. I think there are some quite interesting things happening. I know some of the other sessions will be touching on this today as well, but around the regulation of responsible investing and about putting better labels in place really to help investors understand what they are buying into. I'm talking particularly about investment funds here. So you may well have heard the FCA has been consulting on new labels that should come into effect next year in the UK. There are 3 of them, I think. One of them is particularly interesting. It's called the Improvers label, which I think really caters to that, the issue that there isn't black and white in ESG. It's not that this is good and this is bad. There's a huge amount of middle and companies that can improve. And that Improvers label is all about asset managers engaging with companies to help them become more sustainable over time. Now, from the investor's perspective, I think this feeds into a desire for a much more tangible feeling or outcome when you're buying into some sort of responsible investment product. Sometimes if you're just buying something that's got ESG screens in place, actually what they're doing is perhaps mitigating more financial risks as opposed to giving you a tangible outcome that's improving the environment or society. So I think the move towards some of these labels could be really healthy. And the other aspect within this is sort of a demand for thematic investing. So buying into funds investing in renewable energy. You know exactly what's in that product. You know that that's feeding into the sort of transition economy. And I think that can be very satisfying too. So quite a few developments going on, both in terms of demand, but also at the regulatory end, and how products are going to be looking in the near future.
Dan, I'd like you to pick up, from your research, because you're obviously writing articles all the time about the different trends emerging, and certainly Mark's mentioned a few there. We're obviously going to be talking about ESG and sustainable energies and in this area a bit later on in the day, but actually it'd be really good to get your thoughts, because it's dominant, isn't it?
It's certainly dominant still at an institutional level. That interest isn't going to go away probably ever now, really, for a number of reasons. I mean, from a private investor point of view, things are a bit more mixed at the moment because of this intersection of valuations with interest rates. Again, on the one hand, the high growth stocks obviously came into this period of the rate hiking cycle on rich valuations, and they've struggled a little bit. The other side of things from private investors, their interests, I imagine, would be the investment trusts, the wind trusts and things like that, who have struggled on the one hand with higher discount rates, but also with inflation, increasing the costs of some of these projects. It's easy, I think, in investment to identify a theme that's clearly going to be a growth area in the economy and think that automatically leads to good investment returns forever. Those kind of portfolios have done very well this year, though. We've seen they're saying, even though one of the aspects on which these trusts rely is, government subsidies and fixed price agreements, things like that, they're now saying, well, actually, these subsidies aren't enough. There was a wind auction recently by the UK government where there were no bids for that very reason. So even these portfolios that would seem to be a safer and more reliable way to play the ESG story, the sustainable investment story, the energy transition, have struggled this year. And it's difficult.
They're not stable enough, are they? That's the problem.
Well, and to a degree they are stable, but obviously all investors would like some growth and they would like some income, and it's harder for both that growth to materialize and for that income to keep growing at a time where you've had several years of price appreciation already. So it's a difficult area, and I think sustainable investors are now having to confront that fundamental question again of what matters more, the return or ultimately what they're doing with their money, because for a few years you could have your cake and eat it, and maybe that's not quite the case anymore.
I want to hear your thoughts on this, Yohei, and pick up off Dan.
Yeah, ESG is a big term. In three in one, I think it would be easier to have things a bit more simplified. Just green. And green renewable energies now also have an advantage because they're also seen as a means of, improving security, because green energy renewables can be produced at home and you're not reliant on oil coming from not so great countries or countries that now with two wars going on, so I think with higher oil prices or fear of losing oil supply, I think especially the renewables, the green and nuclear energy will receive more investment. So that'll be a way to, one investment tool that is good for security, good for the environment, and eventually good for returns.
Now, there's no doubt that we're living through some really tough times at the moment. We've had a number of conflicts that have emerged, as we're all well aware of. I want to know, from your perspective, how can investors make their money work hard for them during really difficult times?
Yeah, I think one thing our users ask about a lot when it comes to kind of tackling the uncertainty is, what are the things you can directly control? And when we think about building products, that's what we think about a lot. So on one hand, of course, you want to make sure you're in the right markets and the right geographies, but you also want to make sure that you have the right tools. And I think a lot of the investment platforms across the UK, they're not doing things like passing on higher yields on the cash that you have sitting in your account while you wait to invest. We see our users are investing very internationally to diversify across currencies and across geographies, and they get charged foreign exchange fees every time they make a transaction. And so actually the thing that is very in direct control when you think about investing in the next year is making sure that you don't lose on the edges. And yeah, it's the same with commission fees and fund fees, and making sure if you get a money market fund, you're actually investing in the place where you have the lowest cost. So I think that's a tangible thing that any investor can action today that will improve their returns.
Dan, what's your perspective on this?
I think that's right. At a time where returns are harder to come by, every basis point does count, and it's only natural people will be looking at costs even more, and there are certainly some of these costs, whether it be FX costs or whether it be overall platform costs that are too high, are problematic in some cases. That said, it's very difficult to transfer money between platforms, which is a separate issue. So there's a bit of a bind there for some people. I know the regulator is looking at things like interest rates on cash on investment platforms, for instance. So if you're dismayed by some of those, there may be some change there. Equally, I mean, making money work harder for you. The ultimate question is, it's the very old cliche, but I'll use it anyway. It's time in the market, not timing the market. So you can have some money on deposit or in bonds, what have you, but you don't want to be trying to catch that upturn in sentiment when it does come, because if you miss out on a few good days, you could really miss out on a big chunk of long-term returns. So those cash rates are attractive, and well, in some cases they're attractive. Hopefully they're not too bad on everyone here and their individual platforms and the money they've got on deposit. But equally, you need to be mindful, I think, that investing, it is a long-term practice that we're all involved in, or all talking about and interested in. So you've got to bear that in mind, that trying to time when to come out, when to come in, that kind of thing is almost impossible to get right.
Yohei, do you agree? Do you agree with Dan about that? That it's about the long term that you've got to be thinking about?
It is about the long term. Population is getting older. We're going to live each time. I mean, life expectancy is growing, and we're going to live more of our lives after retirement. So yeah, long term is now.
Mark?
Yes, certainly we hear about this all the time from the advisors we're speaking to. They're having very difficult conversations with their clients all the time about risk tolerance and whether they're going to stay in the markets or going to be drawn into a fixed term deposit where there's so much more safety. People are still feeling a bit burnt after 2022. It really just comes back to what's been said. For long-term returns, you're going to have to take a bit more risk, and these are the conversations that are taking place everywhere at the moment, I think.
Dan, I'm going to come back to, initially you talked about the individual sectors and looking into those a bit more in terms of a global economic outlook. Let's start with your thoughts about the future, as it were.
Well, yeah, it's another tough one, isn't it? If I had all the answers,
you'd be rich.
Well, indeed, and hopefully our readers would too. But that's what we tried to do, so I should give it a stab. I mean, last year, in theory, it seemed, just to go back 12 months again, in theory, it seemed, banks benefiting from rising rates, hunker down in some defensives. Some of those plays haven't worked so well. For next year, on the one hand, again, you could look at some growth-sensitive shares, sectors that have been hit very hard, thinking about that turn when it comes. Equally, I'm not sure that, the valuations on offer for some growth stocks have quite acknowledge the reality of the world we're in. So it's difficult for some of those racy areas. When you look at the defensives, they've got their own problems. A lot of defensive sectors, the big dividend payers. Of course, you can pick up that dividend and pick up some very good yields nowadays, high single digits, low double digits on some big, UK stocks, which is a great opportunity. At the same time, you've got to realize in a lot of these cases, I think that these are bond proxies, so at a time of bond yields rising, as we've seen, that capital is going to be, affected even after quite a dismal year for, the likes of some insurers and some large cap dividend payers. So, as ever, there are pluses and minuses. I mean, that from the dividend perspective, again, you take the long-term view, you're happy to pick up that yield. That is very attractive now on some of those defensive sectors. The growth side, it's harder. I think you need to look not even on a sector-by-sector basis nowadays, but case-by-case basis. Look at some shares this year, like Rolls-Royce, for example, which no one a year ago would have described as a growth stock particularly, but its valuation had been so bombed out, and all it needed to do was get that cash flow to come through. It's got a new chief executive who's taken quite a critical point of view. And you can really see that turnaround happening very quickly. So it's that kind of story, I think. And there are a lot of those stories in the UK. There are companies that have been on the downturn for a while now where there is some latent value to be unlocked, but it needs to be on a case-by-case basis, I think.
Do you agree with that, Mark? I'm going to open up the floor in a bit, so get those questions ready. But do you agree with that from what you've seen? Case by case rather than sector?
I think so, yeah. I mean, it does require a lot of research and digging deeper, and it goes back to perhaps what I was saying earlier about the slight disparity between how investors feel about the economic outlook for UK and how they're actually a bit more buoyant when it comes to seeing the UK as quite a strong investment destination. So I think for those who are clued up in doing their homework, they can spot these pretty good opportunities ahead.
Okay, so time to hear your voice now. So if you've got a question, please put your hand up and we'll get a microphone to you. Oh, look, loads of keen people. Also, when you ask your question, please let us know who you want to answer it, or they all can. Gentleman at the front, we've got a microphone there. Or maybe you can, oh, here we go. Just at the front here. Do you want to stand up, sir?
Yeah, sure.
Be easier, then everyone can see. You sit up. Here we go. Thank you.
So this is a question to the panel. If we go back in history, if I start to look at 1987, 1988, we saw some interest rates were around 16.5% at that period of time. We had a war with the Falklands at that period of time. We had equity prices on property reducing substantially to the level of like 30%. If we look at the economics today, we're looking at geopolitical, we're looking at inflationary issues, interest rate issues, which certainly are not in the same comparison as they were 87, 88, but they're still substantial. But the banks are still making obviously lots of profit as a means to do. If we look at the stock market, we're looking at volatility. If we're looking at a lot of investments, volatility, yes, I agree with the sentiment across bonds, because at a time of uncertainty, people want to go safe, naturally. My question to the panel is, are we, and by the way, one further factor is we've got 2 elections next year as well. So, being the theme of today, I'm very keen to understand on a hope basis, an individual basis, what sort of expected outcomes could we have for 2024 leading into 2025 with all of this rather interesting turbulence activity? Thank you.
Good question, thank you. Who wants to start with that?
I
Mark, I see a smile there. Left to right.
Start down at this end, what's coming? Yeah, I suppose as an individual, it does all look pretty grim at the moment, doesn't it? It's hard to deny that. But with one eye on the future, that adversity, there's always opportunity, and people, all the investors we speak to, clearly do have an eye on the future and the sort of things that could be of interest to them in the next 12 to 24 months. That's exactly the sort of time period we're asking them about. One word you'll be hearing, I'm sure, a lot today is AI, or just technology in general. This has leapt up in demand, I guess, investor demand this year. It's the first time where we've really been hearing that from the end investors as an area of real interest, as opposed to the professional investors who might have been talking about it for some time. So massive growth opportunity potentially coming down the line, whatever else is happening in the world. I think for me, the penny dropped on that only a few months ago. Before that, hearing about ChatGPT, it seemed to have fairly dubious uses like doing your homework and writing stories about cats and who knows what. We have started testing a piece of software at work, some qualitative analysis software that could reduce a week's worth of work into maybe half a day. It's an incredible productivity boost. So I think, if you go away and look into that and something you're interested in, if you're working, maybe your line of work, you can see these incredible opportunities that could be coming down the line in that space too. I realise that's just one example of many, but maybe I'll hand over to the panel for some other thoughts.
Yeah, well, I'll continue the point about AI. Yeah, it's an incredible productivity boost. I use it a lot. But I think that investors might become a bit more suspicious towards AI because regulation is also coming towards AI. And so I don't want to kill the enthusiasm because I really enjoy ChatGPT, but I think the investment expectations might be a bit over the top. And I want to also about future next year, and yeah, I'm from Israel, and now it's a time of crisis, but as you said, crisis is also opportunity or there's an... So after the 73 war, 4 years later, we had the Egyptian president come to Israel and there was a peace accord. So I want to stay optimistic also about the prospects of the current conflicts, Israel, Hamas and Ukraine, Russia. And regarding the elections, then I think eventually, as we see from by-elections, not by-elections, it's called the special elections in the US and midterms, I think eventually Biden will win, but it's going to be a very, very volatile year with lots of polls and lots of responses from stock markets, but eventually we'll have a bit more stability towards the end of the year and looking into 2025, so that's my crystal ball for you, for what it's worth. And
yeah, I mean, I don't have that much more wisdom to add. I think for me there are two things that give me hope. One is, hopefully as inflation eases and interest rates are high, at least my cash that's waiting to get into the market is getting a good yield. And underlying, so I'm building a technology firm, and I believe a lot in the underlying power of technology and innovation that will power improvements in productivity across listed companies that eventually will translate into continued returns, even though it's a bit choppy right now. So I'm very hopeful that by the end of next year, we'll get there.
I mean, something could go terribly wrong. Something could always go terribly wrong. Quite often it's the unknown, isn't it? Last year we had the budget, and then there was LDI, which a few people had warned about. There certainly was a consensus view this year. Rising rates, but people weren't necessarily thinking about US banks' books of interest rates that they weren't marking to market. To go back to the election point, I always think about 2020, where there was a lot of concern around the last election, 2 elections ago rather, 2016, about Trump getting in and what would happen. It would be terrible for markets, and then he won. It was a big surprise, and markets went up. So it's very hard to draw conclusions ahead of time about what might happen in these situations. That's not to say at all the same would happen this time, who knows. I do think though, to an extent, investing for the long term, investing in equities, you are putting your faith in human ingenuity in general, not just talking about AI and specifically, but about new technology, about you're backing innovation, you're backing humanity ultimately to succeed, to put it in a probably slightly too grandiose terms. So there is always that element of hope there as an equity investor, but to an extent it's part of existence as well. There could well be something terrible happening next year. I think even at the time when interest rates were at zero, we had a pandemic, of course, coming out of nowhere, and I'm certainly not ruling those things out, but at the same time, I think if we focus on the long term, if you think about building wealth over the long term, then ultimately you have to put your faith in things ultimately being okay. And if they're not ultimately okay, then we probably have bigger problems to worry about than portfolios anyway.
Yeah, that's very nicely put, actually, Dan. Faith and a bit of optimism. Thank you for that question. It was really good. Next one, please. Over here, there's a gentleman there. Please do stand up. The microphone's on its way to you very quickly. That's great.
Thank you. Is the age of buy and hold over?
Let's start with you, Wanda.
I don't think so. In the user behavior that we see a lot of people that back companies for a long period of time because they have conviction in the long-term stories. And I think the same is true for buying, holding the whole market. Like if you believe in average human ingenuity and you don't want to spend too much of your time figuring out which company is going to represent that, then you can buy and hold the market, and historically that's gone fairly well for you. And I think we see in a lot of our investors that they want good tools to understand what long-term trends are so that they can be a part of them rather than be very active. But I think it's probably a very individual question to the individual investor.
You okay?
Yeah, I would agree. Like everything, it's individual, but I don't think it's over. Buy and hold makes sense. Most people don't have time or the energy to change their profiles, and also buying and holding gives you a sense of belonging. So, and we humans, we like feeling this sense of belonging. So, I don't think it's going to change anytime soon.
Yeah, really echo what the panel said. Perhaps a little bit about your sort of
We want conflict.
about your sort of core satellite approach. Some is buy and hold, some a little bit more tinkering around the edges as different opportunities arise.
Unfortunately, I mean, I'm going to agree, perhaps unsurprisingly.
Fortunately, Dan.
Yeah. I'm not sure whether you were asking the question from the point of view of, I don't know, societal attention span, a lot more short-termism, or whether it's more because markets are very difficult right now. Of course, there is an impulse to chop and change. But even aside from all my highfalutin pronouncements just now, the other fundamental point about equities is that compounding over time. And I think to do away with that or try and move away from that wouldn't be advisable, because that is how returns are ultimately made.
Okay, time for another question. I can't even see at the back because of the lights. Here we go. Microphone's moving on its own.
Could the simplistic idea being an improvement in investment in the UK be simply down to the fact that the pound has been cheap for the last 6 years?
Could you hear that properly?
I missed the beginning of the question.
Do you mind just repeating the question?
Certainly. To simplify things, I mean, forgetting interest rate, forgetting about interest rates, forgetting about elections, and what Trump's doing and what's happening here, there, and everywhere. Could the fact that there's an improvement in investment in the UK be simply down to the fact that the pound has been so cheap for the last 5 or 6 years?
Did you get that? Should we start with you, Mark?
Are we talking about the investor sentiment towards the UK, sorry? Or,
Yes.
Quite possibly. I guess the UK, certainly within the European context, is a little bit unusual, given the FTSE 100 tends to do quite well based on what's going on in other parts of the world and the strength and weakness of the pound. So yes, that can be quite beneficial, certainly to large cap stocks. I guess when you look further down, small and mid caps, it's a bit more of a mixed picture in terms of performance. But yeah, the pound certainly has an important role to play at the large cap end of the spectrum in particular.
Yohei?
Yeah, certainly agree. And pound plays a role, and the FTSE is quite international, so the weakness of the pound has an impact. Yeah. Nothing more to add.
Yeah, I think I'd echo that. Maybe I can. The other perspective I would add to that is what we're seeing in our users is that actually a lot of them are investing, especially British users are investing in UK stocks, but particularly also international stocks, and that I think is a trend you see a lot in retail investors, that more and more they're investing in US equities and European equities too. So I guess that's maybe a bit of a contrarian trend that went in the other direction a little bit, but I think I echo what the rest of the panel said.
I mean, yes, if you're a UK investor investing in overseas funds and things like that, you've had an artificial uplift from the weakness of the pound, has helped bail out some of those areas perhaps. But there's no doubt that sentiment internationally towards the UK has been poor. We've seen that in the value of the pound. Conversely, yes, the pound is relatively weak, and it doesn't take much of a move when sentiment is at such low levels for that to change. Whether the pound itself will strengthen, currency is not so much my area, but it would seem maybe that might be less likely if the UK is going to cut rates ahead of some other regions, the US, for example, but whether that happens, we'll see.
Gentleman at the front here has a question. Thank you for that. Thank you.
Hi. First question. Do you understand the dynamics of UK index-linked gilts? And would you buy them now? Because they're pretty bombed out, unlike there's inflation, which is kind of weird to me. Right, that's the first one. Secondly, there is another vehicle, which is granny bonds, right? A lot of which are maturing, and the government's trying to squeeze people out of these. Would you remain in them, given that it's now CPI linked, not RPI linked? And you could, as a corollary, you could say, would you switch out of granny bonds into index-linked, if you like, index-linked gilts at this point?
Dan, let's start with you.
I mean, index-linked gilts are an interesting one because, again, they would have seemed a couple of years ago to be a no-brainer, right? And yet, certainly, last year inflation was soaring and some of these bonds were getting hit very hard. I think there are two reasons for that. The one being they are priced off inflation expectations rather than actual inflation. So unless you get in early and ride that kind of increase and see that happening, then you're going to struggle. And the second reason, and the reason you're going to struggle is because a lot of these index-linked bonds are very long dated. So ultimately, the longer dated the bond, the more sensitive it is to interest rate changes. So if you're buying at the time when interest rates are going up, you're going to get cleaned out on that basis, irrespective of the index-linked aspect. So I think that's why index-linked bonds have done so badly. Right now, I mean, I do think that opportunity has passed as well. If you're pricing off inflation expectations, unless we see a sudden belief that inflation will start rising again rapidly, and okay, we do have some conflicts, that kind of thing, but I don't think, as it stands, that's going to change the overall picture for inflation. Unless we see that, then given the structure and the way they're dated, if you want a bond, I think you'd be better off in a normal gilt at the moment. Probably a similar situation for the granny bonds. I don't know the exact intricacies there, but again, if you're CPI linked, you've already lost that, what I presume is RPI before, you've already been downgraded. At this time, if you're having to reinvest, index-linked bonds, we saw last year that they're not a done deal, and maybe that'll be the same again next year.
So you would keep
Oh.
Well, I mean, it depends on the yield and how long till maturity, and 3 years. 3 years to maturity. What's the current yield you're getting CPI linked? 6%. I mean, yes. I mean, the tax implication is important as well, which we won't go into. And this is not personal advice, I should say, but maybe I would. Yes, maybe I would. Maybe.
There's free
yes.
advice here,
Yeah.
isn't there? Anyone else want to
Definitely have nothing to
help
add to
the
that.
gentleman? Mark, have you got anything to say?
It's not my area of expertise. I can make a sort of related point, I guess, in terms of how professional investors have been trying to inflation-proof portfolios. Probably not a huge surprise, but certainly in the alternative segments of the portfolios, we've seen a real downturn in demand for any real estate exposure and a pretty big upturn in demand for infrastructure exposure as well, given the sort of inflation-linked potential of the returns there. That's been a much stronger trend than we've seen in any other European country. So I'm afraid it doesn't really answer your question, but it sort of relates to it somewhat.
Time for another question. There's one here at the front here as well. Thank you. Thanks for that.
So as you know, America is heavily in debt. Where do you see the debt problem with America when it comes to all the mounting debt they've built up? And do you see it spilling over to Europe in terms of worldwide debt?
Good question. Yohei.
Yeah. I'm optimistic. I think, higher interest rates mean higher debt servicing costs for everybody. The debt crisis in Europe was not that long ago, and the US has these occasional events of panic around the debt ceiling and government shutdowns, which are less severe. And of course, inflation brought us higher interest rates, higher yields, and now inflation hasn't fallen enough, and governments are still funding, have a lot of debt, but I'm optimistic. I think, as I said, at the beginning, that central banks will jump to the rescue, and the Federal Reserve is squeezing its balance sheet by $95 billion every month. I think they'll eventually stop that. I mean, stopped raising rates, maybe one more, and eventually they'll cut rates, and even before cutting rates, I think they'll begin halting this program and supporting basically funding the government in a better way. And also here in Europe, there's a lot of urge to protect. That means more government spending, especially with the war on the eastern flank. So I think this fire will be extinguished. Any potential for a debt crisis will be extinguished with the first spark, and not turn into another debt crisis.
We're coming to the end of our session now, so I'd like to get your final thoughts actually from each of our panelists. Thank you for all those questions. I'm sure if you want to ask more questions, you will be happy to answer them after the session. Wanda, let's get your final thoughts.
Yes, I think what I'd comment, it was a pleasure to be on the panel with all of you. Right, so as we're in a phase where interest rates are high and there's more and more uncertainty, I think I'd focus on the areas that you can control. So make sure that you don't get ripped off on yield that's not getting passed on to you by your broker. Make sure you're investing in a platform that's ready for an increasingly global world where you don't pay too much on FX fees, and watch every penny to make sure you make the most of 2024.
Dan.
I suppose I don't really want to repeat what I said at the start, but that is essentially my view. I mean, there's no doubt sentiment is still relatively poor across the board, certainly when it comes to domestic shares, but things will improve at some point. That's not very insightful, I realise, but we've gone through this period now with high inflation. The rate hiking cycle is, at least it would seem, at an end, so it's about that downslope. But even then, in the meantime, there are always individual opportunities out there. Companies who are either doing something different, or there's been a shift in sentiment there because of sometimes simply how bombed out they've got. In the UK, as I said earlier as well, you've got good yields you can pick up on a lot of companies, with the additional benefit compared with cash and bonds of potentially some capital growth in the mix in the long term, and dividend growth perhaps too. So investing is a long-term pursuit, as we all know, and we've got to keep that in mind. It's almost impossible behaviorally to do that, but we've got to try and remind ourselves of these things. Next year, you always look forward with optimism, I hope, to a degree. You always hope it'll be better, and maybe some of those stars are aligning equally. We could be saying the same in 12 months' time, but that's the nature of investing, I think. Sometimes we've had a very good period for 10 years, and we've come through this tougher period now, and perhaps we were all treated far too kindly by the era of low interest rates, but ultimately, if you want that long-term wealth accumulation, then equities are still the way to go.
Thank you. Yohei.
I'm optimistic for next year. I think we'll have a bit of an unhappy Christmas. The world seems much darker now, so I don't think we'll have a Santa rally, what's called in America. But for 2024, I think things will get better in terms of interest rates will begin falling, and stocks will begin rising. That's my optimistic view, and hopefully we'll have fewer conflicts as well. But it's going to take time. Probably it's going to get a bit worse before it gets better, and that'll affect markets. One thing that probably isn't going away, even if my projection is right and interest rates will fall, I still expect volatility to remain relatively high. Everywhere, it's not going to be. We're not returning to a comatose world anytime soon in terms of markets. So I watch every penny, and that's it.
Mark, you got the final.
Sure. I'd say, look at what everyone else is thinking and decide, do you want to go with the crowd or be contrarian? That's your sort of personal choice. The crowd, based on our research, is saying positive on the US still, relatively positive on the UK as an investment destination, again because of that home bias, and looking further afield, really strong uptick in demand for Indian equities this year. China's an interesting one. It's still pretty strong despite all the talk we hear about deglobalization and decoupling from China. There is a lot of investor appetite for Chinese exposure still, but for those who are thinking of moving away and more of that China plus one type strategy, Vietnam is growing very strongly in terms of investor demand. Other countries that may benefit from that sort of reshoring or friendshoring, whatever shoring trend you want to use, might include a country like Mexico, right on the doorstep of the US. So these are the sort of things investors are talking about and thinking about at the moment. And like I say, do you go with them, or do you do something a bit different? That's up to you.
Well, so to sum up there, Mark, you're saying positive outlook from your research of the US and relatively positive in the UK. Yohei, let me see where I've written here. Unhappy Xmas. World seems darker, but there's an improvement to come in 2024. Things will get better in terms of interest rates. Wanda, watch every penny. That's good advice. Dan, things will improve at some point. So I'm not sure what the takeaways are, but it does conclude our session there. That was the Lunchtime Summit panel session, the Global Outlook, Economic Outlook for 2024 at the London Investors Show. A huge thank you to my special guests here, Yohei, Ela, Mark McPhee, Wanda Rutgers, Dan Jones. I think you'll all agree they've been really brilliant and answered your questions extremely well. They were quite difficult. And a huge thanks to all of you for being wonderful participants. It's been a great session. Enjoy the rest of your day. I've been Adira Tudor. Thank you.